Yeah, it is now. That's fine. I can delete because I've got to edit the front of it anyway. Right, let's go. So, hello. Welcome to this week's podcast. Wherever you are tuning in around the world, it's great to have you here. So basically today, we get to think outside the box and explore some of the other avenues of investing, because this week's guest has got an incredible story of how she came to London from New Zealand at just the age of 23. She was 4 years younger than I did, with just 30 quid in her pocket. And she's never looked back since. She's now a savvy investor, a money and wealth coach. So if you've been struggling, maybe financially, maybe you've got, you're not sure about your money, maybe it comes in and it goes out, or maybe it doesn't come around enough for you, then this one's for you. Or you could actually be on the other end of the spectrum where you've got enough income, but you want to start to invest and you're not sure how to get started. That's a great thing with my guest today, Vix Munro. Her mission is to help women to create and build wealth so they can live the lives that they want. So over to you, Vix. Welcome. It's awesome to have you here on the Iconic Wealth podcast.
Oh, I'm so excited to be here. And yeah, what a great introduction. Thank you.
Thank you. It's my pleasure. So we've started to get to know each other through the Iconic Wealth community. And I want to take it back because I actually haven't heard your full story yet. So let's go back to the beginning a bit. Kind of, obviously, those that are tuning in know that I'm originally from Australia, but I didn't come over till I was 27 and I had more than 30 quid in my pocket. So I'm really looking forward to kind of what happened in relation to you coming to New Zealand to London, and how did it feel turning up in another country with just 30 quid in your pocket?
Well, it wasn't planned to only arrive with £30. Basically, I'd been a student back in New Zealand, then I'd kind of worked and I'd had some student debts, and I managed to get enough money together for the flight. And we also went traveling. I came with a girlfriend, and we went traveling for 2 weeks in Australia, so your home country, and then 7 weeks in Southeast Asia. And obviously, we hadn't budgeted very well. I did very well then. And we just spent a lot more money. And it was things like, I remember going to Singapore, went to Malaysia, went to Thailand. And in Singapore, I bought a camera, because in those days, Singapore was the place to buy kind of, technology, which in those days was a camera. Nowadays it's different, isn't it? And it was like, oh, we're in Singapore, we're never going to get a camera for this price again. And then we took some some flights in Southeast Asia when we were planning to go on overnight buses and do it cheap, and stayed at a couple of nice places. So the next thing we knew, we arrived and we both had £30 each, basically, because we pretty much had the same amount of money and we were spending the same amount, spending money on the same things. And that's what we had. But we were very lucky because my friend knew someone in London. So she had somewhere for us to stay. So we basically slept on the floor on they're kind of like yoga mats. I can't remember what they used to call them in those days, but you used to sleep on them in your tent. We didn't have a tent, but we had those. So we slept on someone's floor on those for a month. And we both got jobs really quickly. I'd studied accountancy at university in New Zealand. So I got a job in the city working for a Japanese bank. I mean, it took a while for my money to come through because I think I was paid weekly, which is great, rather than permanent job here in the UK when you get paid monthly. So that was a good thing. And my friend, she got paid daily because she got a job in a cafe. Wow. So we were able to survive. But yeah, it was, I wouldn't recommend it. I certainly wouldn't do it now.
Yeah.
It's like, oh, well, we'll figure something out. £30, we can always go to a youth hostel. But I remember spending £6 immediately on a zone 1 and 2 travel card. That's how much they cost. I don't even know how much one costs now because, I don't buy them, but that's what that's the first thing we spent. So we had £24 left. But as I said, my friend got a job, I think, the next day. And then she got paid that day. So we kind of had money to live on. And in that month, we slept on one of her friend's floors. We saved up enough money for a deposit for a flat and to get our own flat. So, yeah, it worked out well. And we were really lucky. And also, the thing is, I got a job in a Japanese bank. And somehow, partly because of the exchange rate, partly because wages and at that time were much higher here in London than the UK. Back in New Zealand, I felt like I was earning quite a lot of money working in a bank. And there was also lots of work and lots of overtime available. And it was like time and a half if you did more than 7 hours a day. and double time if you work the weekend. So for quite a few months, I worked like 7 days a week, 10 hours a day to make money, and I wanted money to go traveling. And given that I only arrived for 30 quid, I didn't have any put aside for that. So and that was an interesting experience as well, to suddenly feel like I was earning a lot of money. And when I converted it back into New Zealand dollars, it was like, wow, I feel like a little millionaire here.
I love
But
that.
it's different now for young people, because I met a young English woman the other day when I was getting my hair cut or something. And, a few years ago, I think it was pre-COVID, she'd been to Australia and said, oh, how much you get paid in Australia compared to here? I'm like, oh, in my day, for New Zealand, and it was the same for Australia as well, I think, the pay rates were much higher here.
Yeah, definitely. When I left, the same pay rates were nowhere near what they were here, but now they've definitely started to catch up. But I love that, because I think character building for me is around travel. So I always recommend anyone travel, because I think it does build your character, it builds your resilience, it builds your adaptability, how quick you can kind of alter what you're used to living with. I think very, very quickly. So I remember having those days in London going, why am I here? I can't afford a thing. So I love that that's how you got started. So and then kind of I guess you've come a long way now, you're literally out the other side now, but tell us a little bit about your journey. So what's some of kind of the biggest maybe turning points in your life that got you started on your wealth creation journey today? Because you're a highly successful investor. You've built a property portfolio, you've got your own business, that sort of thing. So what are some of the things that people can learn from along the way that you feel like's impacted your life the most since then?
Well, I did have some experiences. Like, I did end up in debt here in the UK, mainly because I decided to go back to university. I clearly love studying. I did economics and Spanish. I spent a year abroad in Madrid. I then went on and did a master's degree in economics. And by the time I finished that, I thought, right, by then I'm in my early 30s. And I'm kind of like, okay, I've got it. I started to think, okay, what am I going to do with my life? But at least I had a corporate job. So, by that point I had a good income, but I still had a student loan. I bought a car. I had a car loan. And then I decided to buy a house, because in actual fact, when I first came to the UK, house prices were really increasing here in the UK, and people were buying them and they were going up so much. And I'm like, oh, I wish I could buy a flat, because, I just saw kind of, dollar signs, kuching type thing. But obviously I wasn't in position. I had a temp job. I wasn't British. Well, I wasn't British at the time. I'm now got dual nationalities. So I now have a British passport as well. So that wasn't possible. But once I came out of university and finished my master's and I had a corporate job, I decided to buy a flat. And at that point, they'd dropped in value quite a lot. So it turned out to be a really good time to buy. I didn't know they're going to drop any more, but I just thought, actually, they're much cheaper than what they were a few years ago. I'm going to buy. So I bought a flat. And then it was really a couple of years after that, or maybe around about the same time, that the book Rich Dad, Poor Dad came out by Robert Kiyosaki. So that was actually quite a turning point moment for that, because I read that book and thought, oh, wow, real estate, that's a great thing to get into. That was one. But actually the biggest turning point for me in my life ever was, well, it happened when I was 11. My mother died when I was 11 and she was 35. So she was very young to have died. And I think as a result of that, I got into a bit of a spend kind of mentality. Like, I'm here for a good time, not a long time. And it was when I became the same age as my mother when she died. In fact, when I kind of surpassed her. So it was around that 35, 36 year mark that I'm suddenly, things kind of started to go on in my head, thinking, oh, I might be here for a while, And it's really interesting, because I've talked to other women who lost their mother as children, and I've read books. There's a book called Motherless Daughters. And one thing they often say is that, when they become older than their mother was when she died, it's kind of a real turning point. And it was for me. And it was, I was then 36. My mum had died at 35. I'd lived longer than she had. I kind of thought, oh, maybe I better do something. And that's when I, decided to buy my first investment property. And as I said, I'd read Rich Dad, Poor Dad a few years earlier. So it was kind of those two things combined really, kind of the education and the information from Rich Dad, Poor Dad, and, my coming of age in many ways. But it was, a significant age for me. So I bought my first investment property, and I was very lucky because the reason I was able to do that, because I hadn't saved any money. I had a car loan, a student loan. And the other thing I didn't say is, when I bought my flat, I'd come out of 5 years of studying, so I didn't really have any money. So a very good friend of mine, very good friend, actually the same one that I came to the UK with, many, many years ago. She took out a car loan in her name. I better not say what her name is in case the bank come after her.
Didn't buy a car?
No, she didn't buy a car. She lent me the money for the deposit when I bought my flat.
Yeah.
So then I had that loan to pay back as well. But I was really lucky because I bought my flat, which I was living in, at a good time, and it had gone up in value. So in order to buy my first investment property, I just remortgaged it. Like, I didn't save for it. I took out equity and I used that as a deposit for my first investment property. And then I was kind of starting to save a little bit of money, and it was just a time when property prices started going off. So, it went up again. And then a couple of years later, I took out more equity to buy another investment property. And it kind of went like that. And I really focused on property for maybe 10 years. I thought property's the way to go. It's the way forward. I mean, I did invest in stocks and shares through a corporate pension, and I spoke to the financial advisor that was dealing with. But I suppose after about 10 years, I started to think, actually, maybe I need to diversify a little. I've kind of got all my eggs in one basket. It's in property. I'd seen that there have been property crashes in the past, and I'd started to get interested in where my corporate pension was being invested. I, of course, went for high risk because I have quite a high risk threshold.
You do, yeah.
So I started then to look at my investments generally, and I started to, I had done some investing in stocks and shares previously, but not a lot. And I hadn't really educated myself that well, apart from property education. And that started with Rich Dad Poor Dad. I then read other books and, other stuff about property. So I started to read books about money, started investing. I mean, I can't remember when I took my first ISA out, and I bought some gold and silver. And then in 2017, I started investing in crypto. And then I think it was maybe around about the same time. I'd have to go back and check, but maybe around about the same time I started investing in crypto. I then also started investing in startups.
Cool.
My first one was, we're 22 now. Yeah, it would have been 2017 or 2018 because it's been around four plus years.
Brilliant.
So I started investing in startups.
Before we get into that, I want to take you back to a couple of things, because there's a couple of really big, I think, big lessons in this. And I think something you can share a value around what you've talked about so far too. So I think one of them is the savviness and the mindset it took to invest while you were in debt. Because, there's a lot of people out there that have those sorts of debts, but then they wouldn't go and buy property, or they wouldn't go and invest. And, part of the wealth journey I always talk about is you should be investing along the way, no matter what, if you can.
Me too.
So, what sort of mindset did it take to go from sort of knowing you've already got this debt hanging over your head to go, actually, I'm going to get into more debt, but more strategic debt, I call it. Because obviously you bought property. So was there a mindset shift that did that, or a lesson in there for anyone else that's in that situation?
Yeah, absolutely. And I actually think I'd already had that mindset shift, or it was more partly education, and it was from reading Rich Dad Poor Dad. Because if you read Rich Dad Poor Dad, and I haven't read it for a long time, so I'm doing it on memory from a long time, but he talks a lot about the whole thing about using leverage, uses the term leverage, I think, rather than debt, and how that's a way to get ahead. You're essentially using someone else's money, and then someone else is paying you rent, and all you need is an initial deposit, and then how you can build your property portfolio over time. So I'd already had the strategic input from that book, and I think from a mindset thing, I was just like, well, the debt's low interest, and why would I want to pay this back when I can make so much more money from property? And my own flat had already gone up a lot in value, that had enabled me to buy additional properties. And then I have you go from 1 to 2, then you've got 2 to remortgage, and you go from 2 to 3, then you've got 3 to remortgage, etc. in the future. So I think for me, the mindset shift was kind of a natural one. I know other people don't see it the same. And I will also say, though, to be fair, it was a different time then. I think it's harder to do property now than it was then. I mean, I'm still doing it. I'm looking to go into Airbnb, where most of my properties are kind of residential accommodation. I have a place in Malaysia, which I'm actually going to soon, which is like holiday accommodation, etc. But most of my properties are residential accommodation. So I'm still looking at doing property now. So I still think it's a really good investment. But it was easier back then because here in the UK, there were much more tax breaks, things like that.
Yeah, it's definitely I think it's definitely shifted to a bit more of a longer term gain as well, rather than, you're not necessarily looking for those short term growths, like you said, to be able to remortgage fast. I think it's definitely a lot more of a longer term strategy than it was before, for sure. But I love that you've touched on.
There's different, but now I will say now with property, there's different things to do. Like now you can get investments from other people. You can, collaborate with other people, because now you've got social media and internet, which makes, what makes it so much easier. Well, I first did it back in 98, and I think the internet was just started around about that time, but we weren't using it to the same extent that we are now. But now you see things like, people are buying properties with no money down, they're doing deals. So there's different opportunities now.
Yeah, definitely. And it's definitely a strategy that, I think anyone in their portfolio should have. I talk about in the online business space to go, look, you're making this money, now go and invest in property, go and do something with it. Because again, it's rich dad, poor dad, is buying assets, isn't it? It's having assets that generate income. I'm looking at, like you said, rolling my pension into a SAS next year to do exactly the same thing, to borrow to get another property. So I think I really love that. I think the thing that comes out of me around your debt as well is reframing debt. Because I was listening to a money mindset coach the other day. We were talking around how people have such a negative connotation to debt. And, debt, it's not always the best thing to be in, but you also have to thank it for what it's done for you. So, even if it's that holiday that you needed the break and had the space to spend with your family, and now you've got to pay it off, whatever, is trying to recognize that debt got you somewhere, it got you doing something for some reason. Because if you reframe it and turn it into a positive, you're more likely to get rid of it in the first place. But also, like you said, you can see opportunities in it. And I think that, I remember having a friend talking about remortgaging. I remember having a friend in London, and I won't mention names either, but, she basically inherited her property from her family. So, she had a house in Chiswick, and it was, she was still young. She was probably early to mid 30s by then, virtually had a 500 grand house paid off. Virtually. And I said to her, you want to have kids? Like, she wanted to have kids in the next few years. I said, right, go and borrow now. And she would never borrow against it. And I was like, oh my God, you could buy 3 properties now, have someone else paying them off for you, but they're your kids' potential future mortgage. And she would never do it. I could not get her to shift her mindset to see that now was the time to take that risk. And I think that's why I touched on that with you, because it is an interesting shift that people have to make, because especially when you're younger, it's like you've got to take risks younger. I think when you're there, so many get tied up in having their own home for the rest of their life. And, she had a prime opportunity there to set not only herself up for legacy for future, but also to help her kids get on the property ladder, to put them through better unis, to never have to struggle with paying that again. And yet she would not risk even putting a 50,000 loan against her property. And she had a 500 grand asset. Crazy.
Some people have a very low risk threshold.
Oh,
and
huge.
Even actually Morgan, I can't remember how to say his last name, Morgan Housel, who wrote The Psychology of Money, he says the same, actually, that what does he talk about? I can't remember the words he used. There's a really good quote of his, which I use, and I can't remember what it says. But effectively what he means is that he personally would rather have a mortgage-free house than take that risk, because of the security and the benefits he brings him. And this is someone who's writing about the psychology of money. So I do think, one, it's partly mindset, but 2, it's really your risk threshold. And for some people, security is so important to them, and it means so much that the risk is too big.
Yeah,
So I
it's
do get
interesting.
that.
Well, that's clearly what she had. So, but
Yeah,
whereas, like you said, from my side, I come from the opposite. I was like, are you crazy? Like, you've got 500
yeah,
grand potential cash flow there that, you know, don't have to borrow from anyone else. It's like literally your own pocket of money you're sitting on. And yeah,
yeah.
it's funny, but yeah, that's why I picked up that around your debt, talking
Yeah,
about
people,
kind
you know,
of,
it's interesting how people, and I agree with you, for some people it's
mm,
mindset and it's a
mm,
lack of understanding, but for some people, even when you explain it to them, it's like, it's still not worth it. It's not
yeah,
worth the risk.
risk
And
threshold. Yeah.
yeah, need
Yeah,
to
it's
understand
fascinating.
people's risk
Mindsets, yeah, because
threshold.
she was in it. She was in a high-powered corporate job as well, doing 6 figures, and it's like she wouldn't borrow 50. I was like, just 50 grand, like that'll get you another place. It's like, no, would not touch it. Yeah, I kept trying to get her to lend to me instead, but she wouldn't do that either. I was like,
Yeah,
well, if you don't want it, I'll borrow it and I'll go and make some money and then I'll bring back.
I'll have it.
But anyway, sidetrack. But that's really helpful because I think that, you know, realize that if you're in debt, you can get out of it, but also don't stop growing at the same time. So I think that's the important message out of that for me is, you know, you didn't stop growing, you kept going no matter whether you had it or you didn't. So it's maneuvering. So I think that's really, really important. I think that, so before we get into how you invest now, what are some of the kind of, you know, you're a very different investor now. You're very savvy. You're very high, like you said, you've got a really high risk threshold. So I love the way you think outside the box in relation to your investment. But if you don't, are there any steps that you can kind of take? Like you said, you've mentioned reading. Like I love Rich Dad Poor Dad too. I've read it probably 2 or 3 times. You know, is there anything else you can recommend to people to kind of shift their investment thought process?
I think sometimes I mean, it depends on the person. I would say, you know, just start. A lot of people are cautious about investing. It's like, oh, and one of the questions, is it the right time? Should I do it now? And, you know, the whole thing is it'd be nice. Yeah, we all want to buy low, whether it's a property, whether it's stocks and shares, whatever. We all want to buy low and sell high. But the thing is, we can't time the market. I mean, if you look at the stocks and shares market, even the housing market, they go up and down. But the overall trajectory is kind of up. It's not a straight line to get there. So my thing is just start and don't be put off by, oh, it might go down next week. And one of the things I always say is, you know, if you're investing, it's for the long term. So think decades. Don't think about what it's doing today or even the next couple of days or even months or even a couple of years. You've got to think, what's it going to be like in 10, 20 years' time? Because one thing I see a lot is people are worried, like, you know, about investing now, or but the stock market's dropped or housing prices might drop or whatever. And if you're an investor, okay, you might decide, you know, I'm not going to wait 6 months and see what's going on. And like at this particular time in the UK, for example, we've got rising interest rates. So, you know, you obviously want to fix your interest rate. Well, potentially want to fix your interest rate. But I kind of think just start. Don't let that kind of fear about what might happen put you off, because it doesn't matter what happens tomorrow. It doesn't matter what happens this year. It's about what happens in 10 years' time. And so ask yourself, okay, if it drops tomorrow, what do you think will happen in 10 years' time? Do you think it'll still be dropping?
Yeah,
So
I
that's
love
one
that.
thing. So that's first thing.
Yep,
So yeah, don't be fearful. Um, and
just
then
start.
you just start. And then the other thing is it's not too late, because I see a lot of women say, oh, I've left it too late. You know, women in their 40s are saying that, but one in their 50s, oh, it's too late. I should have started when I'm 20. Well, I didn't start until I was 36, which is obviously earlier than, you know, someone starting now in their 40s. But, you know, investing for 10 years is better than not investing. Investing for 5 years is better than not investing. Do you know what I mean? It's like, it's still not too late. There's still time. And I see that used a lot. Maybe it's an excuse. I don't know. But yeah, it's not too late.
Yeah, again, I think it'd be probably an element of fear factor. It's like you said, it's another risk thing, isn't it? When you're a bit older, it's like, oh, but I need it here, or I might not be there, or. But I'm with you. I know so many people that have turned their lives around over 40 who were literally broke. So I hear
Yeah.
stories like that continually, where, you know, I met someone the other day who was 52 and went bankrupt because of an ex, a divorce, a separate, all this sort of stuff going on, a business breakdown. And they turned their life back around in 3 years, and now they're financially free
Yeah.
again. So I think that is the thing. So I love that. They're really powerful lessons there. So guys, don't be fearful, just start. And that triggers a comment, because I know we talked about this before around starting with little money. So if you have little money, can you still get started investing?
Absolutely. I mean, you can, if you want to invest in stocks and shares or funds, which is a group of stocks and shares, you can start with a very, very small amount each month. You could start with £5 or £10 or whatever, really. A lot of people think you need to be rich to invest. It's actually the opposite. You get rich by investing. So you've got to turn that around. And people think you need to have lots of money. No, start small and then build up over time. If you're struggling because there's not much money left over, then start small. And in actual fact, again, I'll turn that around. I'd automate my investments because that's paying yourself first. That's actually looking after your future self. Automate that so that goes out each month and then you spend what's left.
Yep, I love that. I just started one about 6 months ago now, I think, and I did the same. I was like, why did I put it off? It's crazy. It's like, so I just started a stock ISA for a, oh my God, I've just gone blank what they're called. Index tracker thing. No, it's through an ISA, but it's an index tracker. So same thing. So my money comes out my account each month. It's direct debit. I don't see it. I don't think about it. Now I've got used to it coming out. And again, I think about people have all these subscriptions and nice to haves, and it's like, did you know that if you just put one away, even your Netflix, if you put that away every month, that can create you a significant amount in the future. So start to think about that. Yeah.
And you raise a really good point because, people said to me, I haven't really got any money to invest. And that's one of the things that you've said that I say, list all your subscriptions that you're paying each month. And I'm really guilty of this as well. I'm bad at cancelling them myself. So I know what it's like. And look at which one don't you use, or which one do you use the least? What would your life be like if you didn't have that? Okay, cancel it for now, invest it each month and see how you feel. If you really, in 6 months' time, if you feel that, life is awful without that subscription, okay, do it again. But in most cases, it's kind of like, actually, I could probably do a few more. And, I could certainly cancel more than I have. So I'm guilty as well. Guilty as charged.
But I love that, though, because I think when we're budgeting and stuff like that, you don't want to always look at taking stuff away. But sometimes it is one small set. Like, you don't realize, like I was saying to someone the other day, because of lockdown, I started using a couple of the apps. I'd never used the apps for deliveries or anything like that. And one of them I looked at the other day and I redid the price on it. And I was like, oh my God, like it was crazy. The markup just from not getting out of my house to go and pick it up to get it delivered. And I was well, there was and I only do it once every now and again. I don't do it on a regular basis, but I can imagine a lot of people do. So I was like, actually, even if I just took that 120 quid a month, that's what it was. It was about 20 quid difference. It was crazy. And I was like, how many people do that on a weekly basis that can't just live without one takeaway, one delivery that, you have to either get up and go and make it yourself or do something different and get creative. That's their investment pot into a fund. And it was those little things. It's like, it's not about sacrifices. It's about strategic investment. Yeah.
And also it's about, when I talk about spending, I'm saying only spend on things that, bring you joy in a Marie Kondo kind of way. You can Marie Kondo your spending too, because a lot of the time, and again, I'm guilty as well. And I try and ask myself this question and, I don't always succeed, but I'm a much better now than what I used to be. Like, how much joy is this going to give me in a Marie Kondo kind of way? And if it's not a 9 or 10, why are you spending money on it?
Yeah.
And that money that's money that could be spent on something else, either something that does give you joy or a 9 or 10, or could be invested for your future self on something that will give her joy at a 9 or 10.
Yeah, I really like that. Yeah, because you're saving for something that might give you bigger joy, like me traveling, same as you.
Yeah, exactly.
It's like that money, extra business class flight or the extra hotel. It's like what brings you joy, and it's like that takes that little bit of saving, a little bit of extra to get to where you want to go. Yeah, really powerful.
And also, I think if you're spending money, spend on the things that you really enjoy doing. Like, I really love to travel, so I'm happy to spend money on travel. I'm not so bothered about clothes. So I'm like, okay, if I'm going to cut something, I'm going to cut my clothes.
Yeah, budget. It's like me. I'm not a designer handbag or high heels.
Yeah, I don't want to give up my holiday, but I am prepared to give that up for future. So future me can have more holidays.
Yeah, I really love that. So future pace yourself. So let's talk about a little bit about you, where you're at now. So tell us a bit about where you're at now, what you get involved in. So we started to talk about some of your startups, but also you're a money and wealth coach. So kind of what do you notice around, especially around women entrepreneurs, who's the audience for this, you're probably tuning in, listening, ladies. What do you notice about women entrepreneurs in relation to their investments, their money and their wealth sort of mindset in relation to kind of what you do now?
Yeah, so I think one of the first things I'm going to say is that I see that women are much more comfortable saving than investing. And by saving, I mean they've got money in the bank earning not very much in interest. As you know, well, interest rates have been very, very low. They're starting to go up now. But, if you mentioned tracker funds, so let's take the S&P 500, which is an index fund, an index fund or a tracker fund that tracks the S&P 500, which is an index of 500 large companies in the US. Historically, since the beginning of time, on average, that has returned 10% per year. Now, some years that will be more, some years it will be less, and some years it might even decrease. But on average, over time, so over the long time, that's 10%. Whereas, I mean, I don't know what you're going to get in the bank at the moment. 2% interest, maybe in a high yield savings.
I don't even do anymore, do you?
Well, I mean,
in a high savings one, I suppose. Yeah.
Yeah, high yield. I mean, I haven't looked recently actually, but Chase were doing 1.5%. They have gone up a little bit now, so maybe it would be higher. But that's a big difference. And
that's
one
huge.
thing I talk about is the rule of 72, which tells you how long it takes to double your money, and it's basically 72 divided by the interest rate. So say if you're getting 2% interest in your bank, then it's going to take you 72 divided by 2 is 36 years to double your money. Now, if you're getting 10% per year from, say, an index tracker like the S&P 500, and that's based on historical data, 72 divided by 10 is just over is 7.2, so just over 7 years. I mean, that's a huge difference. 36 years to double your money by having it in the bank, or just over 7 years to double your money by investing in an index tracker. Huge difference.
Huge. Like I didn't know about the rule of 72, so that's really interesting. I love that. And I guess, and the other thing that people don't think about is they don't think about the compounding effect. So they don't think about reinvesting either. So you might start with, like you said, 1,000, you might start with 100 or whatever. But as you're adding in and compounding, does that factor into the rule of 72?
Yes.
Is it compounding?
Yeah.
It does. Okay,
yes,
cool.
It does. Because the thing with compounding, you get time. The longer you're in, the better, because you've got time to compound. But also the higher rate of return works in your favor as well with the compounding. So that's, the rule of 72 takes it into account.
Brilliant. I didn't realize that. Yeah, that's awesome. But it is a small thing. So like I was listening to, I love Ann Wilson, the Wealth Chef. And I was listening to her the other day around index trackers and stuff. And like she said, one of the biggest things that people don't look for is the fees on index trackers.
Yeah, exactly.
So when you're looking at fees, you want to get as minimal fees as you possibly can, because that was it was a huge difference in return over 7 years.
Yeah.
Because of the money you're not paying on a fee, you're reinvesting into your fund.
Exactly.
And it was crazy. It literally doubled her fund, one of her funds in that time period, just from removing the high level fees. Yeah. So
that's
think
crazy.
about fees
so,
as well.
That's the thing you need to look at. Yeah, you do need to look at fees. It's a very good point. When you're investing, how much is this going to cost? How much does it cost me? And what else could I do with that money? Oh, I could invest it.
Yeah, well, I think it was a 2%, like it was like some of them are 2 to 5% fees, whereas the one that they recommended something like 0.4%. So the difference in that over that same period of time was it went from something like a 70 grand account to 140 grand account, just from removing the fees. It was crazy. So look for fees as well. But I really love that. So and again, it reminds you to getting started. So in relation to kind of women entrepreneurs as well, in relation to them getting started investing. So we've talked about some of the mindset things. What's your kind of 3 or 4 things that they can do to get into the habit of investing, or maybe just change the way they think about their money? Because obviously you're great with money coaching, and we all talk about blocks. We all talk about imposter syndrome. Like there's so much, I guess in a way, I get annoyed with it sometimes. There's so much jargon in the industry around money blocks. But what's your insight into that? What do you feel around in relation to kind of money and how women operate compared to sometimes maybe even men?
Well, women are more cautious. I mean, as I said, that's one of the reasons why they tend to save rather than invest. Also feel that, whereas men are a bit more gung-ho, oh yeah, I got this, I know how to invest, whereas women feel that they don't want to invest until they're more knowledgeable about the topic. Whereas in actual fact, what you've just been talking about with Ann Wilson and index trackers, it's not rocket science. It's actually not that difficult to understand. So I actually think the basic financial education is really important, because once you kind of understand the basics, I think you'll feel a lot more comfortable about investing. So that's one thing. Two, I think, kind of feel your way. Like, even if you can afford to invest more, maybe just start with £10, £20 a month, just see what it looks like, just get into the habit of doing it. You can do it on an app in this day and age, and then you can watch it and see, oh, okay, well, it went down a bit, the market's down, it might go up a bit, and just feel comfortable. And also, and I think, you raised a good point about, mindset, because mindset is important for everything. And I think just generally, if you want to become, build wealth, it's not just about financial strategies. I mean, the best financial strategies will only take you so far. You need a strong money mindset as well. And when you have both, that's when the magic happens. So I do think, anything we can do to work on our money mindset is good. So, challenge some of your limiting beliefs. If you believe that rich people are greedy, why? Who told you that? Where does that come from? How many rich people do you know that are greedy? And I mean, and then challenge it. How many rich people do you know that actually aren't greedy and actually generous and kind and things like that? So it's about, working on the mindset is really important too. So we all have limiting beliefs that maybe we don't deserve to be wealthy or don't deserve to receive or whatever we have. But it's really important to work on those as well. So that's why I say the two go hand in hand. It's financial strategies and mindset together.
Brilliant. I love it. And I love that you kind of get, like you said, get comfortable with investing. I think that's really powerful as well. Get comfortable building that habit, get comfortable taking it out. And that's why I like the index trackers. You can it's literally something you can set and forget and get started with. You don't have to learn everything, but I do think education is powerful. Like you said, get some basic knowledge. I'm looking at another investment course coming up, so I'm always learning, always growing, and always getting excited about things. So I think that's the other thing is don't be scared to play. It's like crypto. We hear this a lot, and I'm sure you'll give you insight into this, but it's like, oh, I couldn't possibly do that because I'm going to lose it. And it's like, okay, so play with a bit of money that you can. So, for me, I just go, okay, I don't know where it's going to go. There's a lot of people made a lot of money with it. And I wish I'd kind of got in a bit earlier and actually had a bit more of a play. But I think sometimes people get so emotionally attached to it. And I'm like, okay, can I afford to go just a couple of £100? Yep, put it away, done. Not think about it. And if it works, it works. If it doesn't, it doesn't. And I think that's where sometimes detach on the outcome, because it will give you the first step. Yes. I mean, what's your take on crypto? Obviously, we've got some massive news in crypto at the moment with obviously FTX and everything going on.
Yeah.
What's your kind of take on crypto at the moment in relation to kind of a future? Where do you think?
Well, I mean, the FTX thing is unfortunate situation, really, and it, it's had a bit of an impact on the markets. But for me, the fundamentals of crypto have not changed. FTX was an exchange and they did things wrong, and they, didn't protect investors' investments, etc. And that's why that's happened. And for me, but it doesn't change the fundamentals. Crypto is still crypto. I still believe exactly the same, that I believe that digital assets are the future. But with crypto, there's, I don't know, thousands, like some people say around almost 20,000 different cryptocurrencies now. Not all of these are going to succeed. Many are going to fail. So it is a really volatile space. I believe the big ones like Bitcoin and Ethereum will still do really, really well. And I've been in since 2017. And personally, I love it. And one of the things I always say about crypto, and you've kind of said this yourself as well, is, if you have a diversified portfolio approach, which means you don't just, which means not putting all your eggs in one basket. I think every portfolio can afford to have maybe 1 or 2% in speculative assets. So, if your portfolio is £100,000, then potentially you could afford £1,000 or £2,000 in speculative assets, because in the overall scheme of things, it's not that much. If you think about £1,000 to £2,000, you think, oh, that's a lot. But if it's 1 or 2% of your portfolio, it's actually not that big a deal. But you also need to feel comfortable with that. Now, I have a higher amount allocated to speculative assets in my portfolio, but I'm comfortable with that, and I understand my risk threshold. And with anything that's high risk, you need to, only use money you're prepared to lose.
Yeah.
So you need to always have that in mind, and do your own due diligence. And the other thing I'd say about crypto, which I think FTX was a large, reputable exchange as well.
It was, yeah. Yep.
Yeah,
It can happen to anything. Yeah, I'm a bit like you, because it can happen to anything. Like, I'm a bit like you, because when I first left at work, I got into Forex trading. So I learned to Forex trade, and I actually really enjoy Forex trading. But again, my broker went into receivership overnight. I didn't know anything about it. Like, literally, I went in one day, was trading, off I was for the afternoon, out partying like I was at the time, come back in the next morning to trade, and there was no account. Like, literally no account. My whole account was shut down, gone. And so it can happen to anything. Like, I mean, obviously FTX is a little bit extreme because it is a major player in the Bitcoin market. Yeah. But your money's never safe. A bank can close tomorrow. Like, there's been examples and stories over the last 2 years with various banks withholding money, because as far as they're concerned, if their money's in your account, you actually don't have access to it. There was a guy Rob Moore was talking about the other day. There was a guy that Rob Moore's one of his mates went to get 20 grand out of his own account. They said no. They actually refused him to take his own money out because he couldn't prove what he wanted to spend it on. Now, I don't know when the banks,
I like crypto.
I don't know when the banks decided they can ask you what you're going to spend your own money on. But again, nothing's ever safe.
Bitcoin, because Bitcoin is outside central bank control and outside government control. And that's why I really like it. And that's why I do believe it's the future. But,
I think there's got to be a mix in everyone's portfolio moving forward, I think, for sure.
Yeah. And I think the thing is, I mean, there's a thing that's said in crypto, not your keys, not your crypto, which basically means always store your own crypto. But there's a risk with storing your own crypto, because the risk is that you have a private key and a public key. And if you lose those, you can never access your crypto again. Now, if you store your crypto on the exchange on which you bought the crypto, they manage the keys for you, and you have like a password and a username, or you have your email. So if you forget your password, you can actually get that again. So you do have to understand that, where do you store it? But personally, I would never store everything on one exchange, and I like to have a mix. And I also tend to recommend Coinbase, because Coinbase is the only crypto exchange that's listed on the stock exchange. So in order to become listed on the stock exchange, you have to go through huge scrutiny. They have to go through huge scrutiny by the SEC in the US. So for me, that makes them slightly more,
so it lowers the risk, doesn't it? Lowers the risk. That's all it does.
The risk. I mean, their fees. Some people say their fees are higher than some of the others. I mean, I haven't done a side-by-side comparison of everything, but I think, well, I'd rather take that hit and pay it in this case because of the risk associated with it, and take a slightly higher fee. But when you're talking about with tracker funds, when they're regulated here in the UK and you've got the FCA, I mean, your money is protected in that respect.
Yeah,
so
exactly. Yeah, I really love that. And I think
understanding risk and what you need to do to protect yourself as well.
Yeah, that's huge. So that's the importance, ladies. So if you're tuning in and listening, so like you said, you can get out of financial struggle without any problems. You just have to work for it. You got to think about what you're doing, create a strategy, and change some of your mindset potentially to get out of it. Like we said, don't be scared to invest along the way. So be aware that, you can, even if you're building your business, like that's what put me off. I was like trying to build my business and I was putting everything into that. But actually, I wish I'd started some of the other stuff along the way, because I could have done the same. So I think that that's the key as well, is make sure you are slightly diversifying some of your portfolio beforehand. You don't have to wait to the end. And that includes giving back as well. We were talking about that the other day around giving back. Is like everyone waits till they get to a certain place. And it's like, no, you can make a small impact now along the way as well. So start to think about that in your portfolio as well, is how are you making a difference to someone else's life? Yeah, it's so important, because so many people see philanthropy and investment at the end, don't they? Where they go, when I've made my million, or when I've done this. And it's like, you can do something along the way. So in relation to
small amounts help too.
They do. Small amounts do make a big difference to people's lives. So I love that. So I think that, you've got an incredible wealth of experience, Vix. You've come such a long way from having your 30 quid in your pocket to, being a multi-million investor now. You've got your property portfolio. I love that you get into startups. We haven't really even gone into startups. But in relation to kind of working with you, what's the sort of things that people can do to work with you to kind of, create some of their wealth journey?
Well, yeah. So, I mean, if someone, just wants kind of to get into my world, then join my free Facebook group, the Retire Rich Community. Otherwise, I offer one-to-one coaching packages, financial coaching. That's on my website, Retire Rich with Vix. And I will be launching some programs about wealth creation and other things in 2023. So watch out for those.
Brilliant. That's exciting. I love your website, Retire Rich. It's great. It's a fabulous website. Go and check it out. There's going to be links around this podcast or this video, wherever you're listening in or tuning in. There's going to be some really cool links. So last question for you, Vix, is if you could share one tip around building your wealth today, what would it be?
One tip would be educate yourself financially. And it doesn't need to be to a high level. Just, even if you just get the basics under your belt, I think that will make a big difference.
Brilliant. Love it.
And actually, just one more thing.
Yes, go on.
To add to that, there's actually studies that show that there's an association between financial literacy and wealth.
Brilliant. Yeah, I remember I was reading some statistics not long ago in relation to kind of, women and wealth in relation to where they see themselves. And it's like they said, if they're educated, they're more likely to invest. They're more likely to come out in the end in much further ahead. So I love that. So yes, don't be scared, ladies. There are incredible women out there now starting to teach more about wealth. So, it used to be, I guess, the fear of maybe the stuffy suits and the kind of that sort of environment. Will I be looked down on if I don't know what I'm doing? All that sort of thing. Is any question a stupid question? And I think now there's environments opening up. Iconic Wealth is one of them where we're going to be talking about money and wealth. Go and join Vix's community. There's going to be a link below. Go and join that. They're talking about these types of things. So for me, I think it's really important to surround yourself with incredible women that are openly talking about wealth strategies. They're talking about money. They're talking about what they're investing in, because that's going to make it easier for you to open up and ask questions. So that's why I'd start jumping into Vix's community, get in there, get around people that are already doing it, because then you won't feel like the person outside the box. You'll feel like the person in the box with other people doing it. And that's valuable for me, because if you try and do it in the coffee shop with your mates, they're probably not having the same conversations. So get started. Thank you again for tuning in wherever you are around the globe. It's awesome to have you here. I hope you got some incredible value. I know I have, listening to Vix. I love your story. And we're going to be sharing this very, very shortly. So I look forward to seeing on the next episode of Iconic Wealth for Women. Bye for now. Thanks, Vix.
Thank you. Bye, everyone.